All right, today we're jumping into a really interesting one, TeraWulf. This is a company with, well, two completely different stories fighting for the spotlight. You've got this high-tech AI future on one hand and a ghost story from the age of coal on the other. So we're going to unpack both.
So on one side, you've got the AI dream, right? We're talking a multi-billion-dollar partnership with Google, a pivot into high-performance computing. Sounds amazing. But then on the other side, you have this legacy of distressed debt from failing coal plants, a company kept alive by state subsidies, and this really complex transfer of value that frankly needs some explaining. These are the two competing narratives we're going to break down today.
Okay, so let's dive into that first story, the one about the AI powerhouse. Today, TeraWulf presents itself as a company right at the forefront of the AI revolution. And it started out as a Bitcoin miner, but now it's transforming and fast into a data center operator for what's called high-performance computing, or HPC.
Now, what's really interesting here is that even though Bitcoin mining is still, the vast majority of their revenue, a whopping 86%, the company is clearly at a turning point. That little 14% slice for HPC leases, that's the future they are betting everything on. It's kind of like when Netflix pivoted from mailing you DVDs to streaming. It's a huge deal.
And this pivot, it's been happening incredibly fast. I mean, this quote really nails it. The TeraWulf of today is almost unrecognizable from the company it was just a year ago. That's a dramatic transformation, and it's got the market paying very, very close attention. Okay, so let's talk about the absolute centerpiece of this new AI story, the partnership with Google. And listen, this isn't just some casual handshake agreement. No way. This is a sophisticated, multi-billion-dollar deal that basically validates TeraWulf's entire strategy. So here's how the deal is structured. It's basically got three parts. First, you have TeraWulf. They own the physical stuff, the land, the buildings, the infrastructure. Then you have a company called FluidStack. They come in as the official tenant and operator. But the real key here is step 3, Google. They are the ultimate end user, and, this is crucial, the financial backstop for the whole shebang.
And if you want cold, hard proof of a direct relationship between them, look no further. 41,011,803. That's the exact number of stock warrants, basically the right to buy shares in the future, that TeraWulf granted directly to Google LLC. This isn't some indirect deal through a third party. It's a binding financial relationship right there in the public filing.
So what exactly is this backstop we keep talking about? Well, think of it as a super powerful financial guarantee. It basically means that if FluidStack ever fails to pay its rent, Google has to step in and cover it. This guarantee effectively wraps TeraWulf's debt in Google's own amazing investment-grade credit rating. And that is the key that unlocks billions in low-cost financing for their big expansion plan. So that all sounds pretty incredible, right? A fantastic, forward-looking tech story. But to really get what's going on here, we have to ask a critical question. Where did these massive, power-hungry data center sites actually come from? The answer? Well, it takes us to a very, very different place. And this brings us to story number 2, the ghost of a coal plant. See, before TeraWulf, there was a company called Hirot Power, and what they owned were these aging, unprofitable coal plants in New York. The valuable assets of today? They were the distressed liabilities of yesterday. This timeline really shows you the immense pressure they were under. Back in 2016, the company takes on this massive high-interest loan just to stay afloat. A year later, the coal market completely collapses. By 2019, big institutional investors like Blackstone, they'd walked away, leaving the founder, Paul Prager, in full control of a really troubled company. And then in 2021, the big pivot to a data hub begins. And this chart, this gets right to the heart of the problem. You see, the cost to produce a megawatt hour of electricity at these coal plants was way higher than the price they could sell it for. They were literally losing money with every ton of coal they burned, which made it pretty much impossible to pay back their debt through normal operations. So that brings us to the obvious question, right? If the plants weren't making any money, how on earth did they manage to pay a debt bill of nearly $17 million every single year? Well, the answer wasn't in the market. It was in some, let's say, very clever financial maneuvering. Hero Power basically survived using two main tools. First, they got these state-mandated subsidies by arguing the plants were essential for grid reliability. And second, they launched some really aggressive tax litigation against the local town, and they won, successfully slashing their property assessment from $160 million all the way down to just $20 million.
Okay, now look at this table. The annual payment they owed to their private lender was about $16.8 million, and the annual savings they got from that property tax lawsuit, about $16.4 million. I mean, the numbers are almost identical. It's pretty incredible. And here it is. The key takeaway, summed up perfectly by this forensic report we're looking at. The money saved from the local town's tax base was almost exactly what was needed to pay the high-interest private lenders. You see what happened? It was a direct transfer of wealth from the public sector to private creditors. So that brings us to the final piece of this whole puzzle, the creation of TeraWulf, a publicly traded company. This move became the mechanism to finally resolve that massive legacy debt from the coal era. They effectively turned that old bad debt into new public equity. This table really shows how it all worked. You can see that over several transactions, the new public company, TeraWulf, transferred over $150 million in cash and stock to the private entities controlled by its founder. And that money provided the capital to finally pay off those old distressed lenders from the coal plant days.
So, there you have it. We've unpacked both sides. A futuristic AI powerhouse on one hand, and a super complex resolution of a failed coal business on the other. Now let's bring them together and figure out what this all means for the company today. This slide lays out the two competing ways to look at TeraWulf perfectly. Is it the bull case, a pure play on AI growth with the stamp of approval from Google? Or is it the forensic case, the final chapter in a long, complicated story about resolving distressed debt from a bygone industrial era? But here's the thing, and this is the crucial point. Both of these stories are true. They aren't mutually exclusive. The exciting, high-tech AI future is being built directly on top of the assets, the infrastructure, and the financial resolution of a very, very complicated coal-powered past. One literally couldn't exist without the other.
And so that leaves us with the big final question, doesn't it? Do you see TeraWulf as this brilliant act of industrial reinvention, turning a dying asset into a vital piece of our future infrastructure? Or is it fundamentally a masterful piece of financial engineering designed to resolve a really difficult legacy? The answer, most likely, is that it's both.